Hey, what's going on, guys? Wanted to shoot a quick update video on KURV ETFs and pretty much how they've been performing, what their kind of strategy is, and kind of go over some different numbers that I've kind of calculated here on a spreadsheet. So if you're not familiar with what KURV ETFs is, it's a management company. They have 6 or 7 ETFs, and they're high income ETFs, similar to YIELDMax. They aren't quite as aggressive on the income side as YIELDMax. So with that being said, they will produce smaller yields, but the price return of the funds perform a little bit better there. So looking at, I guess we can look at this November distributions. This just came out a couple weeks ago. So these are some of their funds. TSLP, it's a Tesla-based fund. NFLP, Netflix-based. AAPY, Apple-based. Google, GOOP. AMZP, Amazon-based. Microsoft, MSFY, and then KQQQ is kind of their tech titans, or like their select ETF that they kind of handpick and kind of get in and out of positions with. So it looks like that's the extent of this article. You can see TSLP 59 cents per share, NFLP $1.02, AAPY 29 cents, Goop 38 cents, AMZP 64 cents, MSFI 31 cents, and KQQQ 15 cents. So these numbers don't really mean much if you're not really actively following these funds or an investor of it. But let's go ahead and look at the spreadsheet here and kind of look at the returns for these funds. So looking at the spreadsheet, it looks like NFLP is still the leader of these particular funds. I don't have KQQQ kind of charted out, and I don't really have any data for that fund. So I'll have to circle back to kind of see how that's been performing. But Netflix has been on a tear, and so has NFLP. NFLP started this year around $26 a share. So if you would have just purchased, 100 shares of this fund, it would have cost you roughly $2,600. And your investment of the shares, if you did not drip or anything, would now be worth $3,600. So you're making roughly a 9% price return on the shares, or roughly 35% on a price return basis. So pretty good there. The distribution yield, based upon the distribution calculated, comes in around roughly 26%. And if you include the price returns plus the distributions, you're looking at a 55% return year to date for this fund. So pretty solid, beating the S&P 500. Looks like Tesla's been struggling earlier on, but they've really been rocking and rolling the past couple months. Microsoft, 15%. Goop, 20%. AAPY, 21%. And AMZP, another massive performing one for them, up 38% year to date. So if we can go back and look at some of these funds, talk about their strategies. I think it's the yield premium. Yeah. So we'll show a quick little snippet of this video here to kind of see if we can get some insight from the fund manager.
Welcome to SIBO Issuer Insights. I'm Bill O'Keefe, Director, North American Derivative Sales at SIBO Global Markets. I'm joined today by Howard Chan. He's the CEO and founder of KURV Investment Management. Today we're going to talk about some of their products, and I'm going to ask Howard some questions about his funds, and I'm going to start right now. So Howard, how are your suite of funds, the KURV Yield Premium Single Stock ETFs, doing since the launch on SIBO back last year in October?
Great. Well, first of all, thank you, Bill, for our partnership with SIBO. We did launch a series of 6 single name covered call ETFs last year in October 2023 with SIBO, and they have been performing as expected. The funds generate a distribution yield of roughly between 10 to 30%, depending on what the underlying is. And the single names are mostly technology stocks.
What's the cadence of their call writing? Is it a quarterly, monthly?
Yeah, we generally write monthly calls. We think that's a good balance between yield generation and also making sure that these calls generally, hopefully, expire out of the money so we can fully harvest the premium on the call written.
That's what I want to know. What is the Kurv story? What's your
Yeah.
beginnings? Where'd you come from? How'd you come up with this idea?
So at Kurv, our mission is to actually offer strategies, institutional grade strategies that are tax efficient and option based, and generally a bit cross asset class. And I can go into that a little bit later. And we generally look to solve for portfolio management problems that advisors and their investors have in their portfolios. And the origin story of this is actually we talked to a lot of advisors. Cover call strategies are not new. They've been used since the 80s by the largest wealth managers to generate some additional income, but there's sort of an operational difficulty. So if you're an advisor, maybe the flow is your client calls you, say, please write some cover calls. You have to go through a portfolio maybe of 20, 30 names to figure out which names you want to write cover calls on. If you're at the largest firm, you might have an execution desk that knows how to execute options. And that's almost impossible for a smaller advisor who doesn't have that capability. So we essentially launched this ETF to remove the operational burdens of a cover call strategies, and all the advisors and investors have to do is decide which name and which exposure they want to have in their portfolio.
Interesting. And what do you hear is the most obvious or the loudest in terms of investor challenges in the market?
Yeah, I think, as I mentioned partially, is that there's still a difficulty in accessing options for many advisors. They do much more than investment, right? They do some estate planning. So the portfolio management side, we try to make it as easy as possible for the advisors, not only to gain exposure. And I think one thing that people often don't talk about is if they want to exit a strategy, you have to unwind your trade, right? You have to buy back the cover call that you've sold, and you have to in order to exit the strategy. So now, actually in an ETF format, you can just sell a share of the strategy to exit of that exposure from your portfolio.
Could you go on and explain what the NAV erosion it does to a lot of these income products?
Yeah, that's a common issue that we see in the market, NAV erosion, or oftentimes reverse stock split. And that's basically when you're over distributing or you're targeting a specific yield and you have not been able to generate that amount of yield in your portfolio. The simplest example I would give is maybe you have a rental property that you have a couple of tenants, each paying $2,500 to make up for a monthly income of $5,000. And let's say 1 month, one of the tenants is a little bit late. But to reach that $5,000 income, you decide to sell your kitchen to make up for the difference. And that's almost the equivalent of essentially eating into your principal. Mm-hmm. And so we are fully aware of this phenomenon, and we guard against this in our funds. We generally distribute only the premium that the market gives us, and that's just from the cover calls. And of course, that premium can change, month by month because of what the market pricing of uncertainty is. Yes.
So your funds, what you described as a common practice or issue, your funds are not experiencing that. Your funds are looked at, you're trading them a little differently, I believe here.
Yeah, so in months where we harvest a lot of premiums, we actually hold some back in anticipation that in some months that when we harvest less, we can use up what we call a bank in the fund. And so we can try to produce as consistent as possible the distribution. And in fact, one of the things we have been pretty consistent, we can increase distribution for the rest of the year and still maintain that consistency without NAV erosion.
That's really interesting. I haven't really seen too much of products work in that manner. Last question I have for you, Howard, would you continue to manage the funds in the same way, or would you adjust anything given the current market cycles or investor challenges?
Yeah, so again, as I mentioned, we take a very institutional approach. That's where the strategy came from and how it worked really well. So I had mentioned that we implement various different techniques so we can buy the stock or get the exposure of the long exposure through options, and we try to manage how we write the calls. All of these things are designed to help us navigate different market environments. And we think that based upon our experience on the team, we don't have to dramatically change how we manage it to make sure that the funds can be managed in a consistent way. I will say, in the current environment where there's a lot of volatility, is actually great for a strategy like this. Obviously, when you're writing a cover call, you're harvesting the volatility premium. And so there are more premiums in the market when there are more volatility. And the last thing I was just mentioned is, it's been written quite a bit about how index volatility has been, very low. It's, the 4-year low. And that's partially because in index there's diversification, so volatility is low. So we've seen a lot of investors basically get additional premium from single names and buying a basket of them to get the diversification afterwards. So they get the premium first, then the diversification. And so that's maybe a way that we've seen investors use our fund.
Interesting. Howard, thank you for joining SIBO Issuer Insight. Today I had a pleasure interviewing you. Thank you very much.
Thank you, Bill. Great to be here.
All right, great.
Yeah, so that was a great interview on their website there. So definitely go check that out if you're interested. Once again, that's kurvinvest.com. But once again, these are some of their ETF offerings: AMZP, AAPY, GOOP, MSFY, NFLP, and TSLP. So there was an interesting thing that he mentioned in there that I was not aware of, that it sounds like if they have a really good month as far as harvesting premium, that they'll actually hold back some of that premium so that they're able to continually distribute month after month. Instead of distributing all of it in that one particular month, it sounds like they have a bank or something inside their funds. That something that he mentioned there was pretty interesting. I don't know if I'm a fan of that or not. As an investor, I kind of want all the premium that I can get, but definitely from a fund management side, it makes sense to them, to be able to hold back some of that premium so that they can, continually pay month after month, almost a consistent amount, or close to that consistent amount. But yeah, as far as distribution yields, it looks like NFLP currently is the highest, followed by Tesla, then Amazon, then Google, Microsoft, and Apple. So those are just obviously based upon IVs and how much premium can be generated. This is a good illustration here, talking about their strategy and how they, produce their income. Another video, I'm not going to play that right now. But Howard was the person that was just interviewed. Looks like they have some other members on their team as well. And then all the brokerages that allow it, pretty much all brokerages that I know of, at least the most popular ones, Schwab, Webull, Robinhood, SoFi, Fidelity, E-Trade. Not sure if it's available on international exchanges or anything like that. But yeah. So this is a little bit different than some of the YIELDMax funds. We can see on some of these YIELDMax funds is that the price return on a lot of them are pretty massive in the negative way, right? Like they're distributing a lot, much higher yields, but with that, you're gonna get that NAV erosion. So you almost have to drip your investments in order to kind of stay even. Look at OARC. Back in January of this year, it was $14 a share. It's now $11 a share. So you would have had to drip your dividends, and you still may be down on your overall position compared to like KURV. These are kind of the starting prices at the end of the year, and it looks like all of these are greater than the starting price back in January or whenever these funds were launched. I think they've been over a year now, so January 2nd is the accurate date. But yeah, that's it for today's video. Once again, just kind of wanted to circle back and look at these KURV ETFs. I've seen some other influencers on YouTube talk about them and kind of how they like, these funds a little bit better than some of the other funds from YIELDMax just because there's less NAV erosion per se. But we'll see if they can continually, kind of produce the numbers that they have. GUI. Wow. So is this okay? So this is actually pretty interesting. They have a page on their website that is actually comparing them to the YIELDMax funds. That's pretty crazy. Did not realize they had that, or were able to kind of do that. So they're comparing YIELDMax's GOOPed versus GUI 2024 total return 20% versus 7.54%, and then cumulative total returns since the inception 32% versus 9.68. Wow. So I was not aware that they had this comparison on there, but this is pretty great read here. So definitely go check these out if you're investors of Tesla or GUI. On the YIELDMax side, they have a breakdown comparison of both of those. So really cool write up there. But yeah, guys, that's it for today's video. Please like and subscribe down below.